On August 1st, 2023, the global technology supply chain registered a cardiac arrest that went largely undiagnosed by the mainstream financial press. On that day, the People's Republic of China imposed strict export controls on gallium and germanium, two obscure metals that are chemically non-negotiable for high-speed semiconductors, fiber optic cables, and military-grade radar. In the 30 days following that restriction, Chinese exports of these processed metals didn't just fall, they collapsed to zero. For the first time in the modern digital age, a sovereign power demonstrated the ability to turn off the tap of the periodic table, sending a price shock through the opaque world of spot metal trading that mirrored the initial tremors of the 1973 oil embargo. While equity markets were distracted by AI hype, the physical foundation of that compute power was being quietly fenced off. To understand the next decade of macroeconomics, you do not need to watch the Federal Reserve's dot plot. You need to watch the refining margins of rare earth elements here on Finance Saga. Reserve currency status is not a magical attribute of a central bank. It is a derivative downstream of physical supply chain dominance. To navigate this shift, we need to ignore the political theater and focus strictly on the plumbing of global trade. We are going to use a single mechanism map throughout this analysis to explain how physical monopolies translate into financial hegemony. Picture a flow with three distinct boxes. The first box is the strategic input, the raw collateral that civilization requires to function. Like coal in the 19th century or oil in the 20th, the arrow moves to the second box, the intermediary, the entity that possesses the physical infrastructure to refine, price, and distribute that input. Finally, the arrow lands in the third box, the macro outcome, which is usually the ability to export inflation and maintain a reserve currency. When the flow from box 1 to box 2 is broken, the outcome in box 3 is not a mild recession, it is a regime change in global value. The history of the last 300 years is often taught as a sequence of wars and treaties, but through a financial lens, it is simply a history of energy transition and material control. Every dominant empire has followed an identical capital cycle. First, they achieve low-cost dominance over the primary energy source or material input of the era. Second, they build the capital-intensive midstream infrastructure, the refineries, the coaling stations, the pipelines, that makes competition mathematically impossible for rivals. Third, they denominate the trade of that resource in their own currency, forcing the rest of the world to hold their debt to pay for their energy. This is why the British pound sterling was as good as gold in 1890, and why the US dollar is the global unit of account today. However, the input has changed. We are leaving the age where hydrocarbons were the sole determinant of sovereignty and entering an age where the electromagnetic properties of specific metals determine economic viability. The competitor script focuses heavily on the military inability to build fighter jets, which is a valid concern. But the financial reality is far more pervasive. If you control the supply of neodymium and dysprosium, you do not just control the production of F-35s. You control the cost structure of the entire green energy transition and the deflationary promise of the technology sector. This brings us to the current friction point. The rare earth magnet sector is arguably the most critical choke point in modern industry. These are the 17 elements that allow electric motors to function at high heat and smartphones to display color. The common misconception is that these elements are rare. They are not. They are geologically abundant, found in deposits across the Americas, Australia, and Vietnam. But in finance, geology is irrelevant. Deliverability is everything. For the last 30 years, the developed world engaged in a massive arbitrage trade. We exported the dirty, capital-intensive, and toxic process of refining these metals to China in exchange for cheaper finished goods. This lowered consumer prices in the West and boosted corporate margins. But it created a distinct anomaly in our mechanism map. The West controls the demand, but China controls the intermediary box, the refining capacity. Today, China mines about 70% of the world's rare earths, which is a dominant position, but more importantly, they control over 90% of the processing capacity. That is the difference between having oil in the ground and owning the refinery. You cannot put crude oil in a car, and you cannot put raw, rare earth ore into an iPhone. The spread between digging the rock and selling the magnet is where the leverage lies. By subsidizing this sector for decades, Beijing effectively successfully executed a predatory pricing strategy that bankrupted Western processing facilities, most notably the Mountain Pass mine in California, which went dark in the early 2000s. This was not an accident, it was a mechanism of capturing the intermediary box in our map. When a single player controls 90% of the processing, they possess the pricing power to squeeze margins for everyone else. They can flood the market to kill new competitors, or constrict supply to squeeze foreign industries. We are now seeing the first signals of the constriction phase. The data shows a divergence that should worry any macro investor. While Western capital expenditures on mining are rising, the timeline to bring a processing facility online is roughly 10 years. That is a decade-long duration mismatch. We have a funding gap where the demand for these metals is exponential due to EV mandates and grid modernization. But the supply is inelastic and politically gated. This setup creates a binary risk for the global economy. If the supply remains free-flowing, the green revolution proceeds with a deflationary tailwind. But if the mechanism breaks, if the intermediary restricts flow, then the cost of the energy transition skyrockets, and the inflation targets of Western central banks become mathematically unachievable. To understand how a physical monopoly can force a monetary reset, we have to look at the last time a single island nation controlled the energy of the world. Not with silicon and magnets, but with steam and coal. Most financial history is taught backward, obsessing over the gold standard while ignoring the energy standard that actually underwrote the currency. If you look at the late 19th century, the period known as the Pax Britannica, you might think the British pound was the world's reserve currency because the Bank of England held a lot of gold. That is a correlation, not a cause. The pound was the reserve currency because Britain held the coal. But more specifically, and this connects back to our mechanism map, Britain controlled the intermediary box, the global network of coaling stations. In 1890, a steamship could not cross the ocean on a single tank. It had to stop to refuel. The Royal Navy and British merchant fleet had strategically acquired the only viable deep-water ports at the choke points of global trade: Gibraltar, Cape Town, Singapore, Suez, and Hong Kong. If you were a German or French merchant vessel, you could build a ship, but you could not sail it without buying British coal at a British port. This physical monopoly gave birth to a financial instrument called the Bill on London. The Bill on London was essentially a short-term loan used to finance international trade. Because Britain controlled the shipping lanes and the fuel, London became the insurance and credit hub of the world. If you wanted to ship grain from Argentina to Europe, you financed it in sterling, not because you loved the Queen, but because the physical infrastructure of the trade was British-owned. The mechanism was clear. Strategic input, Welsh anthracite coal, flowed into the intermediary, the coaling station network, resulting in the macro outcome, the sterling as the global unit of account. The currency was simply the receipt for the energy monopoly. However, monopolies on energy transitions are brittle. By 1914, the mechanism shifted. First Lord of the Admiralty, Winston Churchill made the fateful decision to switch the Royal Navy from coal to oil to increase speed and range. In doing so, he accidentally liquidated the British strategic advantage. Britain had coal at home, but it had no oil. The center of gravity shifted across the Atlantic, where the United States was about to demonstrate the most sophisticated example of resource management in history. We often look at the post-Wubby Tweed era, the Bretton Woods system, as a triumph of the Federal Reserve. But the most powerful central bank of the 20th century was not the Fed in Washington. It was the Texas Railroad Commission in Austin. This is a piece of history that has been almost entirely scrubbed from modern economic textbooks, yet it explains exactly why the US dollar replaced the pound. From 1945 to 1971, the United States was the Saudi Arabia of the world. We produced more oil than we could consume, but raw production leads to price volatility, boom and bust cycles that destroy currencies. To prevent this, The Texas Railroad Commission acted as a central bank for energy. They invented prorationing. Every month, they would look at global demand and set a literal allowability percentage for Texas oil wells. If demand was soft, they ordered wells to run at 50% capacity. If demand spiked, they raised the cap to 60% or 70%. By manipulating the flow at the intermediary stage, the Texas Railroad Commission kept the price of oil distinctively stable, effectively pegging energy costs for the U.S. industrial base. This is the hidden pillar of the post-war economic boom. The Federal Reserve could manage the price of money, interest rates, only because the Texas Railroad Commission was managing the price of energy. The U.S. dollar was as good as gold, largely because it was backed by a spare capacity of cheap, price-controlled energy. The mechanism map was perfectly aligned. Infinite domestic supply, input, managed by a state regulator, intermediary, created a stable, low-inflation reserve currency, outcome. But this mechanism has a hard ceiling. To act as the global swing producer, the central bank of oil, you must have spare capacity. You need to be able to turn the taps on when the world needs more. In 1970, the mechanism broke. The U.S. hit peak oil for the first time. Domestic wells were running at 100% capacity just to meet local demand. There was no spare capacity left to regulate the global price. The consequences were immediate and devastating. In 1971, just months after U.S. production peaked, the trade balance turned negative, and Richard Nixon was forced to close the gold window. This was not a coincidence. The loss of physical leverage made the financial peg impossible to maintain. The U.S. lost the ability to dampen volatility. Control of the intermediary box shifted from the Texas Railroad Commission to a new cartel called OPEC. The inflation of the 1970s was simply the market realizing that the dollar had lost its physical collateral. This brings us to the uncomfortable reality of the 2020s. For the last 40 years, the U.S. regained some leverage through financialization and military projection. But we have allowed the intermediary box for the next generation of inputs, rare earths, processed lithium, and refined cobalt, to migrate entirely to East Asia. We are currently in a position that resembles Britain in 1914 more than America in 1945. We have the naval power and the financial capital, but we have outsourced the refueling stations of the new economy. However, history rarely repeats without a twist. There is a seductive argument that technology always solves scarcity, a belief known in economics as the substitution effect. If prices get too high, we will just invent a way around the shortage. This is the primary counterargument to the thesis of Chinese dominance. Skeptics point to the 2008 peak oil scare, where pundits predicted $200 oil and permanent shortages, only to be proven wrong by the shale revolution. It is vital we analyze why that signal misfired, because it holds the key to understanding whether the current rare earth squeeze is a temporary trade dispute or a permanent structural break. In the summer of 2008, just before the Lehman Brothers collapse, the price of Brent crude oil touched $147 a barrel. The narrative consensus was absolute. We had reached peak oil. Reputable investment banks published super spike reports predicting $200 oil was inevitable. The logic was Malthusian and seemingly irrefutable. Geology was finite, demand from emerging markets was infinite, and therefore, prices could only go up. Yet within 6 years, the price of oil didn't double. It collapsed. By 2014, the United States was on its way to becoming the largest oil producer in the world, effectively neutralizing OPEC's pricing power for a decade. This reversal is the standard counterargument to any resource monopoly thesis. It relies on the substitute effect. The high price of 2008 acted as a signal, attracting massive amounts of capital into a niche technology called hydraulic fracturing, or fracking. American wildcatters, funded by cheap debt, applied brute force engineering to shale rock, unlocking reserves that were previously considered unrecoverable. This validated the free market gospel. If you corner a market, you incentivize your own obsolescence. The monopoly creates the price that funds its competitor. However, applying the shale solution template to the current rare earth crisis reveals a fatal flaw in the comparison. The shale revolution worked because the bottleneck was in the first box of our mechanism map, the strategic input. We needed more crude, and fracking found it. But more importantly, the United States already possessed the second box, the intermediary infrastructure. We had the pipelines, the refineries, the deep capital markets, and a legal framework that allowed private landowners to drill holes in their backyards. The path from rock to gas tank was clear, we just needed more rock. The rare earth crisis is structurally different because the bottleneck is not in the ground, it is in the chemistry lab. We have the rock. We do not have the intermediary. To replicate the shale miracle for rare earths, Western nations would need to permit, build, and staff dozens of hydrometallurgical processing plants. Facilities that use acid leaching and solvent extraction to separate elements that are chemically almost identical. This is not a drilling problem. It is a chemical engineering problem wrapped in a regulatory nightmare. You can drill a shale well in weeks. Permitting a rare earth refinery in the West takes, on average, 7 to 10 years. The price signal that saved us in 2008 is currently being suffocated by the red tape of 2025. This structural rigidity brings us to the three signals that suggest we are not on the verge of a shale-style rescue, but rather a deepening of the chokehold. These are quantifiable divergences in the plumbing of the market that have flashed red in the last 12 months. The first signal is the CapEx decoupling. If the market were solving this, we would see a vertical line of capital expenditure, CapEx, growth in Western processing capacity. We see the opposite. While Western governments announce grants and subsidies, actual private sector CapEx in non-Chinese processing is struggling to clear the final investment decision, FID hurdle. Banks are hesitant to lend to these projects because they fear Beijing will simply flood the market and crash prices just as the new Western plants come online, a classic monopolist move known as a washout. Meanwhile, Chinese CapEx is shifting from expansion to efficiency and consolidation, effectively hardening their existing fortress. The divergence shows that private capital does not believe the West can compete on price without a hard floor or tariff protection. The second signal is the strategic reserve inversion. Historically, the U.S. Strategic Petroleum Reserve, SPR, was the world's liquidity buffer. Over the last 3 years, we have drained the SPR to historically low levels to combat consumer price inflation. Conversely, satellite imagery and import data suggest China has been aggressively filling its own strategic reserves, not just of oil, but of industrial metals, copper, and agricultural commodities. They are transferring physical assets from the global market balance sheet to their sovereign balance sheet. In financial terms, the US is selling volatility insurance while China is buying it. When the world's factory starts hoarding raw materials, it is usually a signal that they anticipate a disruption in the flow, one they might be planning to initiate. The third signal is the processing basis spread. In financial markets, this basis is the difference between the spot price of a raw commodity and the price of the finished future product. In the rare earth market, we are seeing a widening spread between the price of raw ore, which the West can produce, and refined oxides, which China controls. This crack spread indicates that the value is not being captured by the miners, it is being captured by the refiners. It is the same logic as an oil refinery making money, even if oil prices fall. By controlling the spread, China can allow Western miners to survive, keeping them just profitable enough to stay in business, while capturing the bulk of the margin at the processing stage. They are effectively turning Western miners into low-margin vassals for Chinese industry. Let's return to the mechanism map one last time to see where this leads. We have established that the strategic input, box 1, is abundant, but the intermediary, box 2, is captured. This capture is defended by a regulatory moat in the West and a predatory pricing threat from the East. This means the macro outcome, box 3, is no longer market-based pricing, it is political pricing. The cost of the magnets in your EV, the guidance system in a missile, or the hard drive in a data center is no longer determined by supply and demand, but by the geopolitical goals of the CCP. This creates a massive blind spot for inflation forecasting. Central banks model inflation based on labor, housing, and energy. They do not have a variable for weaponized supply chains of the periodic table. If the shale revolution was a deflationary shock that allowed interest rates to stay low, the rare earth monopoly is an inflationary tripwire that could force them higher, regardless of what the Fed wants. We are moving from an era of just-in-time efficiency to just-in-case redundancy, and redundancy is inherently inflationary. But how bad could it get? To answer that, we need to quantify the damage in a specific if-then scenario. The most dangerous number in global finance right now is not the federal funds rate. It is the commercial inventory duration of heavy rare earth elements held by Western technology firms. Based on import data and just-in-time manufacturing standards, most high-tech manufacturers operate with roughly 90 to 120 days of physical buffer. This inventory reality allows us to construct a quantified if-then funnel to map the financial consequences of a supply shock. We assign a 60% probability to the slow strangulation base case. In this scenario, China does not issue a blanket ban, but instead utilizes administrative friction, delays in export licenses, stricter environmental audits on exporters, and lowering quotas by 10 to 15% year over year. If this persists for 2 consecutive quarters, the if-then mechanism dictates that spot prices for neodymium and dysprosium will double, but more importantly, the delivery time component of the Purchasing Managers' Index, PMI, will blow out. Historically, a 6-month lag exists between a raw material spike and consumer price inflation. This means that by late 2025, the cost of hardware, servers, EVs, medical imaging would face a structural 15% inflation floor, unrelated to central bank policy. We assign a 30% probability to the kinetic brake alternative case. This is the full weaponization scenario, similar to the 1973 oil embargo or the 2023 gallium restriction, but applied to the entire complex. If China restricts exports of heavy rare earths, specifically terbium and dysprosium, to zero for more than 45 days, the inventory buffer evaporates. The result is not just inflation, it is a cessation of production. Western defense contractors and auto majors would be forced to declare force majeure on deliveries. In this environment, the price of the commodity becomes undefined. It is simply unavailable at any price. The remaining 10% is the nullifier scenario. This would require a geopolitical grand bargain where trade tensions de-escalate rapidly, or a sudden, non-linear breakthrough in material science that allows Tesla or Apple to swap out rare earth magnets for ferrite or iron nitride alternatives at scale. While research is promising, the commercial deployment lag is typically 5 years, making this a negligible factor for the current 18-month risk window. So, in this reordered world, who pays and who benefits? We must look at this through a cash flow lens, stripping away moral judgment. The payers are the entities that are short volatility on physical inputs. This includes the net deficit nations, US, UK, parts of Europe, that consume finished tech goods but do not produce the raw materials. It specifically targets the green transition mandates. Governments that have legally bound themselves to ban internal combustion engines by 2030 or 2035 are the most vulnerable counterparties. They have created a guaranteed bid for rare earths without securing the supply, effectively writing a blank check to the monopolist. The consumer pays this tax through the green premium, the rising cost of electrification passed down through higher vehicle prices and grid utility bills. The beneficiaries are the entities that are long volatility on chaos. This is obviously the resource sovereign, China, which gains geopolitical leverage and the ability to force technology transfers. But the secondary winners are the rund midstream owners, the few non-Chinese processing firms in Australia or Malaysia that are currently operating. In a shortage, their refining margins will expand disproportionately, similar to how oil refiners made record profits in 2022, even as consumers suffered. Additionally, physical commodity trading houses, the Glencores and Trafiguras of the world, stand to profit immensely as they arbitrage the inefficiencies of a fragmented supply chain. Let's finalize our mechanism map to lock this mental model in. We started with Box 1, strategic input, the raw ore. We moved to Box 2, the intermediary, the processing and refining capacity. And we ended at box 3, the macro outcome, reserve currency and inflation. For the last 40 years, the flow was smooth. Box 1 was cheap, box 2 was efficient, outsourced to China, and box 3 was deflation. We got cheap goods, low interest rates, and the great moderation. That flow is now broken at box 2. The intermediary has become a gatekeeper. Because the flow is restricted, box 3 must flip. The macro outcome is no longer deflation, it is the inflation of things. We are entering a cycle where the price of assets, stocks, bonds might struggle, but the price of stuff, energy, metals, food, goes up. This forces a terrifying conclusion for the Federal Reserve and the ECB. You cannot print dysprosium. You cannot QE your way out of a refining bottleneck. The only way to solve a physical shortage is through a massive, capital-intensive investment cycle, building mines, refineries, and recycling plants in the West. This is known as re-industrialization. But here is the catch. Re-industrialization is inherently inflationary. Building factories requires steel, concrete, energy, and labor, all of which compete for resources in an already tight market. To break the Chinese monopoly, the West must engage in a decade-long spending spree that will keep inflation structurally higher than the 2% target. We have to spend money to build the redundancy that we sacrificed for efficiency. The era of the peace dividend, where we could rely on global trade to keep prices down, is over. We are returning to the historical norm where the security of supply commands a premium. The trade of the next decade is not about buying the companies that design the software. It is about owning the assets that allow the hardware to exist. The monopoly on the periodic table is the ultimate leverage. China has played the long game, securing the intermediary box while the West was distracted by the financialization of the economy. Now, the bill is coming due. The next crisis will not be solved by a bailout, it will be endured by a build-out. And until the West rebuilds its physical capacity, the true central bank of the global economy isn't in Washington, D.C. It's in Beijing.